Good morning. It is Monday, December the 1st, 2025. I'm Mark Treadway with your Monday Morning Insights. Crude oil is starting the week supported but not euphoric as OPEC plus ministers have just confirmed their existing production framework for 2025 and 2026 and reiterated that the 8 key voluntary cutters will keep output paused at current levels into early 2026. Preserving a modest floor under prices while keeping flexibility to add barrels back if the market softens. At the same time, Ural's crude benchmarks are still trading under pressure in the mid-50s per barrel as sanctions and logistics issues force Russia to discount heavily to keep flows moving, which tells you there is still plenty of supply sloshing around even as geopolitics stay noisy. If you are trading oil this week, think about fading sharp intraday spikes driven purely by headlines while respecting the OPEC plus downside floor. Sell strength into prior resistance with tight event-aware stops and look for relative value between Russian-linked grades and Brent rather than betting on a runaway trend. In precious metals, gold is quietly grinding higher again with international prices around $4.2 to $7 per troy ounce today, up roughly 0.25% in the session and more than 5% over the past month, reflecting ongoing demand for a macro hedge. In India, one of the world's key physical markets, 24-karat gold is quoted near 130,300 rupees per 10 grams today, underscoring how local prices are echoing the global uptrend despite currency and duty noise. If you are trading gold, think of buying dips towards short-term support rather than chasing breakouts. Scale into long exposure on intraday weakness and finance part of the position with short volatility structures only if your risk capital can absorb a sharp spike on any surprise macro or geopolitical shock. Industrial metals are sending a different signal though, with copper trading close to $5.23 per pound today, up about 0.75% on the day, nearly 4% on the month, and more than 27% year on year as tight mine supply and resilient demand keeps the tape firm. That kind of slow, persistent grind tells you funds are comfortable holding core length rather than trading in and out, and dips have been shallow and well supported. If you're trading copper, lean into the trend but be very deliberate. Run a core long book hedged with short-dated puts or by pairing against a weaker industrial like aluminium, and avoid getting shaken out by routine profit taking as long as the higher lows structure remains intact. Natural gas in Europe remains subdued with benchmark EU contracts recently updated at levels that imply traders expect prices around 29 euros per megawatt hour by year end, reflecting comfortable storage and a muted weather premium so far. The forward curve is relatively flat compared to the crisis years, signaling that the market is more worried about mild demand than sudden supply shocks for now. If you're trading European gas, this is a curve and options market, not a hero trade on the front month. Consider selling volatility and expressing views through calendar spreads, buying cheap upside only around credible, forecast-backed cold snaps instead of paying up for generic winter fear. And on the grain side, Chicago wheat and corn are grinding rather than exploding, with December 2025 wheat futures and December 2025 corn futures both recently supported by short covering and modest gains into first notice triggers, but without any dramatic weather or geopolitical shock to take control of the narrative. Cash corn in the US has been edging higher in the low $4 range per bushel nationally, underscoring that while the worst fears on supply have eased, end user demand and basis are still quietly doing their work underneath the screen. If you're trading wheat and corn, think in spreads instead of outright direction. Work intermonth and inter-contract relationships. Buy value in deferred contracts against front-month softness. And be disciplined about rolling ahead of delivery-related volatility. Coffee and other softs are providing pockets of tradable volatility, with December 2025 coffee futures recently touching 1-week highs as a strong Brazilian real and short covering helped lift prices, reminding everyone that currency and positioning can move this market as much as weather. These are classic positioning plus macro moves rather than a structural change in supply, which means that they can unwind just as quickly. If you are trading coffee, treat this as a trader's tape. Tighten your time frames. Take profits on spikes instead of dreaming of a multi-month moonshot, and watch the real and Brazilian policy headlines as closely as you watch rainfall maps. To put this all together in an operational way, this is a week to respect the quiet strength in gold and copper, the controlled floor in oil, and the range-bound, curve-driven nature of gas and grains rather than swinging for home runs in every contract. The edge is in tracking bases, curves, and cross-commodity relationships with discipline, not trying to outguess the next headline. And this is exactly where Enuit's ETRM solution and trade earns its keep, by giving you trading desk real-time, portfolio-wide visibility into positions, exposures, curves, and credits or across all of these commodities, so you can implement these spreads, hedge and option strategies with confidence, capture basis and volatility opportunities faster than your competitors, and keep your risk and P&L aligned with the story you believe in. That's all for today's Monday Morning Insights. Have a good trading week, and I look forward to speaking to you next week.